All right, thank you, Cheryl. Everybody from Main Street to Wall Street are waiting on the Fed's decision this morning. My next guest thinks it is time for the central bank to rip off the Band-Aid. Joining me right now is Mark Spitznagel. He is Universa Investments Chief Investment Officer and Economic Advisor to Rand Paul's campaign. Mark, good to see you. Thanks so much for joining us.
My pleasure, Maria.
Before we get to the Fed, I want to talk about the report in the Journal about the profits that you made amid the market volatility last month. The Wall Street Journal reporting you made $1 billion on the day the Dow saw an intraday drop of more than 1,000 points. That was 2 Mondays ago. Wow. Tell us, is that true?
Well, of course, I can't speak about specifics of my returns. August was a good month for us. What I can say is, what's important isn't what Universa made. I would say what's important is what Universa's clients didn't lose in the sell-off. I'm a hedge fund manager that actually hedges for his clients. This is something of sort of an old-fashioned idea in this day of sort of gambling on the next Fed bailout.
Yeah, you're not trading and gambling on one Fed move or another, but you certainly look at volatility and use volatility to work for you. Can you talk to us about your strategy as it relates to volatility?
Yeah, well, the gist of it is the asymmetry of it. I mean, we tend to lose or draw sort of most of the time these small battles or skirmishes. But ultimately we win the wars.
Yeah, well, but when you look at what's going on in terms of volatility in the markets and the backdrop in terms of investing, how do you see the world? I mean, what does the backdrop look like, and how does that influence your decisions?
I mean, the unavoidable backdrop today, is central bank interventionism. Great myths die hard. And I think what we're witnessing today is sort of this sort of slow death of one of the great myths in human history. This idea that centrally planned command economies work, that they're even feasible, and that they can be successful. This is one of these sort of enigmatic mythologies of the last 100 years in particular that we've been sort of grappling with. And here we are today, yet again, thinking about this.
When the market dropped that 1,000 points and we saw all that volatility a couple of Mondays ago, you said this is just the beginning. What do you mean by that? What are you expecting in terms of these markets?
Well, again, we're trying to figure out again how this interventionism works, and there isn't a lot of agreement on that. And of course, I feel very strongly that this isn't something that's possible. I mean, let's remember that in the last 100 years, a lot of blood has been shed over this mythology that I'm speaking about. And then here we are today. How did we get here? How did we get here again? There was this notion not long ago of the Bernanke put, the Greenspan put. You're too young to perhaps remember this, but it was sort of a dirty thing to admit that this was sort of part of our investment strategy. But today, it's everyone's investment strategy.
Yeah, we've seen a pretty good sell-off. For the first time in a long time, we saw a better than 10% correction. Do you still think these markets are overvalued?
Oh, they're dramatically overvalued. I mean, the markets are here only because of central bank interventionism. Again, I think that another generation will look back and say, how could you have made that mistake all over again? How could you have sort of failed to understand sort of Hayek's notion of the fatal conceit that central planners can do better than sort of the dispersed knowledge and signals of free market market processes?
Well, we've been debating really how effective QE has been actually this morning, and earlier we talked about maybe the first phase, QE1, when we were in the throes of recession, was needed, but the continuation of that free money was quite harmful.
Of course it was. And there's something sort of self-fulfilling about all this. Is what we've seen in the last 6 years. There's something self-fulfilling about this mythology. But ultimately, and this only in the short run. In the long run, we know that it is ultimately self-defeating. When bureaucrats mandate low interest rates, it doesn't spawn long-term productive investment. What it spawns is this sort of short-term gambling, punting on sort of momentum-driven moves, on levered buybacks. This is the world we're in today.
So what do you think? I mean, when you look at the Federal Reserve and the meeting today and the expectations changes there. Wall Street suddenly is not expecting the Federal Reserve to move again. I know it's just a guess, but do you think we continue on this path, or will we start seeing rates moving, and what's the impact on markets and the economy?
I don't have a lot of insight on what these bureaucrats in Washington are thinking and what they could possibly do next. 25 bips, today, one way or the other, is not going to mean a lot. What matters are the long-term expectations. The markets are not going to be okay with rates that start going up. It's just not going to be okay with that. But 25 bips, that's not even tightening. To me, that's just sort of a little less easing. There's a long way to go before rates come anywhere close to where they would naturally be without all this interventionism. All
right, so it's not going to have a major impact regardless because it's only 25 basis points, and yet the markets aren't going to like the fact that perhaps we're at the beginning of a new cycle of higher interest rates. How do you allocate capital in such an environment? Are there any places to hide if, in fact, we see another market disruption?
Well, for the unsophisticated investor, the place to hide is probably something like cash for the short run. I mean, it's very hard to think. It's the toughest trade there is right now, is to be sitting there earning nothing, and that's probably why it's the right trade. But again, I'll give the Fed all the credit in the world, a little credit at least, if they start this path of tightening. I think it's going to be very hard for them to do. The market is sort of pricing in that if the markets start collapsing as they tighten, they're going to stop tightening. So what does that mean? What is the market actually expecting? It's probably really expecting no tightening, despite what the forward markets are showing.
And when we're looking at valuations here and comparing it to the actual fundamentals going on, I mean, we looked at corporate earnings, and obviously they didn't grow at all in the second quarter. Is that one of the issues that you have, or is it the international environment and the U.S. Continuing to grow while our trading partners are challenged?
Well, I mean, it's a little bit of both. I'm not looking for a catalyst that'll make this happen, and that would be sort of a approximate cause of an ultimate collapse of this, as opposed to the ultimate cause. The ultimate cause, again, is that the markets are are priced the way they are simply because the Fed has mandated interest rates at this unnaturally low level, and all kinds of a bad distortion happens in the economy when the Fed does this. This is a difficult sort of nuanced point to understand. We see as low interest rate, we think that means that people are saving, that there's all this liquidity, and that entrepreneurs are engaging in longer term production. But that's not actually, the opposite happens when it's mandated by the government. Another one of those examples of bureaucrats try to get you to do something and they actually get the opposite happening.
Real quick, are you expecting the kind of day we saw a couple of weeks ago, 1,000 points right out of the gate? I mean, is that going to be sort of commonplace? You think that happens again?
August, if August was scary to people, they ain't seen nothing yet.
Wow. Mark, it's really nice to have you on the show today.
My pleasure.
Thanks
Maria.
so much. Congratulations on the unbelievable performance. Mark Spitznagel joining us there from Universa Investments, CIO. We'll be right back.